that's quite clear when it comes to gold and silver prices. And that is to say that we are still in a very bullish trend, and we are likely to remain so for many years, really as long as governments keep debasing their currencies by printing money and doing this exercise known as fiscal expansion. It's a recipe for lower value of fiat currency and higher value for things that are stores of value like gold and silver. So I'm quite certain that the outlook for gold and silver is good for the foreseeable future. I'm not so sanguine about the prospects for the overall economy. The one thing that has really been a key thread through my whole career is the ability to embrace risk. In fact, not just embrace it, but run into it. I mean, it's a business that is such high risk. It's high risk in every area. It's more high risk than most professionals in the industry even are aware of. If they think for very long, they realize there's risk beyond all of their own professional area: social, political, economic, global, macro, micro, technology risk, exploration risk, discovery risk, all that stuff. It's just everywhere in this business.
Welcome back to Liberty and Finance. We have a first-time guest today. You probably recognize him. Ross Beaty is the director and chairman of both Pan American Silver and Equinox Gold. He joins us this first time Tuesday, October 20th, 2020. Ross, thanks for joining us on the show.
My pleasure.
We were glad to make acquaintances because, first of all, we were both attending, and you were a speaker and I was an exhibitor at the Sprott 2020 Natural Resources Symposium, which was supposed to be in Vancouver. However, we didn't get, it was quite interesting. The night we were making reservations, I talked to Rick Rule and said, hey, my wife and I are making reservations. He said, you might want to hold off on that because I think we're converting to virtual. So this was our first chance to get you on, and glad to have you on our show. You've spoken widely and are widely known as a leader in the precious metals industry on multiple fronts, also an environmental leader in many ways through charities that you have founded and operate and so on. But if you could first take us into a high-level overview of your perception of what is happening right now in our greater economy, but specifically how that's impacting the gold and silver industry.
How to make a 2-minute answer from a question like that is impossible. And the first reason is that I really don't know what's going to happen to the general economy. I mean, there are so many countervailing factors at work here that I really don't know how this is going to end. You could make a very easy case for deflation. You could make a very easy case for inflation. In fact, I think an easier case for inflation. The best case of all, I think, could be made for stagflation, which is not a very happy outcome. You can perhaps expect that North America and Europe will return to growth the way China is right now. But you could even more persuasively, I think, argue that the growth party is over for a long, long time, and it may be over forever. I mean, 3%, 4% global growth, reducing down to maybe 1%. Actually, 1% is far more sustainable for the world. But it's not a terribly happy outcome for many, many players, many industries, many banks, and so on. And as far as the precious metals outlook goes, that I'm much more assured of. I have a fuzzy crystal ball when it comes to the global economy, but I have a pretty good crystal ball that's quite clear when it comes to gold and silver prices. And that is to say that we are still in a very bullish trend, and we are likely to remain so for many years, really as long as governments keep debasing their currencies by printing money and doing this exercise known as fiscal expansion. It's a recipe for lower value of fiat currency and higher value for things that are stores of value like gold and silver. So I'm quite certain that the outlook for gold and silver is good for the foreseeable future. I'm not so sanguine about the prospects for the overall economy. How's that? A little more than 2 minutes, but
that's fine. And a lot of people who lived through, like, for example, the 2010, 2011 spike in precious metals prices might have missed the fact that that was brewing for a long time prior to that. So they might have the idea that run-ups in precious metals prices are very sharp and volatile and precipitous upward and precipitous downward. But you've talked about, and I know we interviewed Pamela and Marianne Aiden from the Aiden Forecast on here, and they gave a similar outlook as you did, saying we've got years ahead of us. In their mind, they called this a mega trend in the forward view of gold. In your view, why? You mentioned because of the policy of currency debasement, that sort of thing. Is there anything else in the current environment that makes you think of that long-term bull rather than a short-term spike ahead?
Yeah, sure. I mean, this is a secular bull market. It actually didn't begin with COVID at all. It began in 2016. That was the breakout from a 4-year bear market, ending in, gold at, say, 1050. So the conditions for positive gold prices have been around for several years, but COVID has just added gasoline to the fire. The conditions were very low interest rates trending negative. And so when interest rates are negative, why hold bonds? You have to look at alternatives, and gold, although it doesn't have any carry value, it doesn't. It's at least better than bonds, and it has all the prospects for higher prices that bonds don't have. So I think I don't know anybody would hold negative or marginal yielding bonds today, particularly in an outlook where I think we're going to have higher inflation in due course. So there's interest rate factors, there's monetary debasement factors, there's actually mine supply side factors where companies just haven't been exploring, haven't been replacing reserves are declining, grades are going down. The mine supply side is bullish for gold and silver, it's bullish for most metals. It takes so long to permit new mines these days, 15 to 20 years to get from a discovery to production, whereas 10 or 20 years, it was only, say, 5 years. And that's because there's more people in more places who have more money to oppose things. And this is a global phenomenon, and it's just taking longer. And governments love regulations. They love it more now than they ever have. There's more hoops you have to go through to start a new mine. It's just a very long process. So you're not going to see a supply side reaction, which normally happens when you have a spike in price, right? Standard economics, demand, supply. Price goes up, demand goes down, supply goes up. That's not likely to happen. In fact, it may be inversely correlated this time, where you have higher gold prices. And when I say gold, I also mean silver. Silver and gold are both precious metals. They're different, but they're tied. They're kind of joined at the hip. Where you have higher gold prices that actually bring in more demand, because generalists are going to get involved in the buying that aren't there typically in the early stages of these bull cycles. They get involved in the latter stages. So they're just starting to get involved right now, I think. And then you have the supply side issues that I just described, which means that as the price goes up, you're not going to see a supply response, but you actually may see more demand. And that's going to be a recipe for even higher prices, leading to the last stage of the bull market will be the sort of frenzy and parabolic move that we've seen in all bubbles. And at that point, you want to be selling like crazy.
You mentioned something that reminds me of a quote we've heard, that there's no bull market like a gold bull market, in that in many bull markets, you may get early sellers who are finally surpassing the price that they got in at long ago, and they're worn out and that kind of thing. But that basically, because there's also a insurance or a risk reduction, risk off component of a gold holder's mindset, that when it starts to run up, it seems to indicate to many people economic or financial trouble ahead. And therefore, rather than right away selling into a rise, there's a tendency to hold on ever tighter to something that's indicating that you're in an environment of escalating risk.
Yeah, that's absolutely true. And you've seen that with the gold market for decades, in fact, for eons. You'll note, though, I didn't say anything about geopolitical risk. I really don't think worrying about the future of the world, worrying about geopolitical tensions, new wars, new chaos, I don't think that's a reason for holding gold anymore. I think it hasn't been a reason for 30 years. And so I just don't think that's a good reason, but you don't need it. Just looking at 5,000 years of economic history, human history, where gold has always been a store of value, where empires always debase their currencies, leading to devaluation. And that's happening today as much as it ever has. But it's not just in the U.S., which is the world's superpower. It's happening in China and in Europe and in Canada, Australia, like everywhere. They're just borrowing money and printing money like we've never seen before. That is a certain recipe for higher gold prices.
You've mentioned quite a bit about metals and the mining industry and how long it takes to get new supply online and permitted, that sort of thing. There's a question from a viewer here. David Wright says, in the coming few years, does Ross expect producers, explorers, or royalty companies to outperform? Please assume already having a diversified portfolio.
Well, I think the answer to that is typically exploration companies outperform, but not every one of them. I mean, it's a very risky business. So you have high risk, high return with successful exploration companies. So if you pick your right exploration company, that's in the latter stages of these bull markets, the exploration companies are the ones that will do best. And the answer or the strategy there should be to have a diversified portfolio looking for the very best of the best, the prospects that are the most interesting, the ones that have the most good geologists saying these are really great companies. They will typically outperform later in the cycle when people have made lots of money on the lower risk companies like the majors and want to move down market a little bit. That's where bull markets beget bull markets, and leading at the end of these phases of these bull markets to really completely crazy valuations for the young, smaller companies that have no actual, tangible value. They have these insane valuations. That again is a good signal to sell when that happens. So it's not happening now. So I would say exploration companies offer pretty good value prospects going forward. Major companies are always lower risk and lower return, but again, in a rising gold price environment, they're going to do pretty well. I mean, look what's happened this year. Most major companies have come close to doubling this year as the gold price moved up $500 an ounce. And that's for obvious reasons. Those are the companies that have solid assets, good balance sheets. Typically, they're making lots of money. They're paying dividends. They're just good investment cases. And that's actually why Warren Buffett bought Barrick. He didn't buy Barrick because he has a love affair with gold all of a sudden. He bought Barrick because Barrick, in this gold environment with rising prices, is just a money machine. It's printing money by producing a huge amount of gold and having this massive leverage to the gold price. So he doesn't need to go to the exploration companies that offer high risk. He goes into Barrick because Barrick is a great cash machine, and that's what Buffett just loves. And he understands the prospects for gold. They're pretty good. So that's going to continue, and dividends are going to go up, and what's not to love about that? So the large companies are low risk, but they don't offer the same kind of gain potential as the smaller companies, and that's just how the world works. Moving to the royalty companies, royalty companies have been the darling of investors for quite a while. They trade at these crazy premiums, 2 to 3 times net asset value, which sort of makes sense in some cases, but doesn't usually make sense. They're highly overvalued in my opinion, but that's because people like the model. That model works especially well in low gold price environments where the royalty companies will do well, even though the producing companies might not be doing very well. So it's a good trade in those environments. I personally don't think it's as good a strategy to buy royalty companies when the gold price is rising, because the leverage to higher prices typically will be in the companies that have big reserves or resources. And when the resources become reserves as the gold price goes up, that offers real tangible value to that company's net asset value. Similarly, they have immediate leverage to the gold price when they have a large production base. So let's just say a company's producing 1 million ounces a year. Gold price goes up $100. Bingo, that's $100 million of value. To a royalty company, they would have maybe 3% of that or 4% of that, let's say. And so you just don't get nearly the same leverage in a royalty company that you do in a solid big producer of gold. And with a large producer, you also don't have the risk in a rising gold price environment. If, however, you believe the gold price is going to go down, the last thing you want to be owning is a gold producer. And that's when you want to buy a royalty company, because the royalty company is going to offer sustainable long-term value in almost any gold price environment. It just doesn't have the leverage.
JP asks, what is Ross's growth strategy now that precious metals prices have risen? Will they buy assets at new levels, or won't growth and margins be trimmed by these new costs?
Yeah, a good question. So I think that the person is asking, what is Pan American's Equinox's strategy for growth? There's really two ways to grow, or there's three ways, I suppose. There's two ways to grow mainly as a mining company. Number one, you explore and discover, and then you build out whatever you've discovered. That's long and hard and risky. And the other real low risk, but rather more expensive, is to combine through merger and acquisition. And that is a game that is very easy to say you want to do, but it's very hard to do. It's one of those things, that takes a lot of dancing. You have to kiss a lot of frogs before you get a princess. And so, that's why in low gold price environments where companies are stressed, they're trying to protect their balance sheet, you don't see a lot of that happening. But in high gold price environments, when things are frothy, you actually see quite a bit of it because companies have lots of money, high share prices, and they want to gamble with that kind of share price, and they make acquisitions. And in a high gold price environment, very often those acquisitions are crazy because they don't offer value. So for us, we did pretty well in both companies, buying low when the gold price was just starting to run a couple of years ago. Pan American bought Tahoe Resources, and it was a transformative acquisition. The deal was worth about $1 billion, and today it's probably worth $5 or $6 billion. So that was a pretty good deal. Equinox did two transactions. They bought a mine in California called Mesquite for 160 million or something like that, and that's basically paid itself off in about a year and a half. So it was a well-timed acquisition. And then last year we acquired, at the end of the year, we acquired a company called Leagold, which had 4 operating mines and a couple of real nice development projects. And it was a perfect bolt-on with Equinox, and the stock's doubled since then. So those were well-timed acquisitions that offered real value. Today, we're looking hard. I mean, our business plan in Equinox is to grow by M&A, trying to get as big as possible to offer investors, scale and lower risk and better balance sheet and ultimate dividends and all that stuff. And so we're still looking, and we've looked. We've kissed a lot of companies, but I'm not sure many of them were frogs. There were some pretty good companies there, and these have to be. 1-on-1 is 3 deals, plus they have to be friendly deals. I mean, I'll never ever do a hostile deal. It's life's too short. So, you've got to work with cooperating partners if you're going to do a deal, and for various reasons, the companies we've looked at quite closely haven't wanted to dance with us, and probably it's because when we're looking for a company to combine with or to acquire. We want value, and so typically we'll look at a company that's undervalued relative to what we think it's worth, and very often the management of those companies agrees. They think it's so undervalued that there's no bloody way they're going to sell their company at these low prices. So, I mean, we're always talking to companies. You never say never, but it's much more difficult to find value in a high gold price environment for sure. Never say never. So there are opportunities. We are constantly looking and talking and. Bankers are always bringing us deals to look at, and the bankers think they're very clever, but they very rarely are. Although they do generate pretty good fees for the banks, but you have to screen them pretty carefully. We've got very, very, very good business development teams in both companies, and in fact, both companies are so well run that I think investors should be comfortable. We're not going to be drunken sailors just buying anything that comes by our screen. But for sure, Equinox is still interested in growing more quickly to get scale quickly, and again take more advantage of this strong gold price environment we see ourselves in. And Pan American too, although Pan American's in such fabulous shape, it's got so much internal growth right now that it's less acquisitive, I would say, than Equinox.
Another macro environment factor it's rather new is this huge drop in the price of oil, because oil and other energy is so necessary for the development of mining assets. It has to help the book of any mining operation to have that access to that low cost energy. Haji says, will mining companies still have a high valuation when oil prices rise in the next commodity boom, or does Ross feel that oil and gas costs will not rise for the next 3 years or so and impact revenues? And does he hedge oil?
Yeah, I think I'm very certain that oil prices are not going to rise beyond today's price to any significant degree, nor gas. The oil market is oversupplied and demand is going down. Those are surefire recipes for lower prices or static prices. So I'm very certain that we're not going to see another oil boom for all manner of reasons. In terms of how the oil price affects profits, that game is over. The oil price was $100. Now it's $40 a barrel. So that savings is already built into most companies' cost bases, and it was very good. It was it depends where, of course. Some mines are far more oil intensive than others. But the real move today is actually from mining companies, regardless of the oil price. The move is to get away from having to use oil to as much a degree as you can, and that's not just in things like diesel fuel for the trucks, but it's also in how you find your power, how you make your electricity. There is a big move towards renewables. We're part of that. We're looking at renewables in several of our operations. In fact, we're already renewably supplied with many operations already. In certain areas like Peru and Argentina, especially. But there's a move to get away from carbon in every part of a mine's operation. A lot of people are focusing on this, both operators and investors. They want you to be part of the transition away from fossil fuels for obvious reasons, to minimize global warming and so on. So this is a very serious thing taken seriously by every company on the planet. Every responsible mining company on the planet, not just what emissions they produce, but what emissions the supply chain produces, the so-called tier 3 emissions. So we're doing that at both companies, and this is going to be a continuing trend. So the oil price is important. In some way, it's maybe 10% of a typical mining company's cost. So if you save, 5%, let's say, on the oil price, it's material. But far more important is the currency of the place you're working in relative to the dollar, local factors that influence the need for supplies in local currency, technological changes that could change how you operate a mine, and so on. Those are even more important, because don't forget, of a mine's cost, typically half of the cost or close to that is labor alone.
And that leads to the next question of, besides your own companies, so both Pan American Silver and Equinox Gold, what other companies, this is from Michael Garcia, what other mining companies is Ross particularly interested in? Now, you talked about from an acquisition standpoint, okay, you're always watching for those, but are there certain competitors whose operations or whatever you particularly admire or are keeping an eye on?
When you're running these companies, you're very, I'm going to say tunnel vision. So when you go to conferences and, just as a general student of the industry, the way I've been for most of my career, and it's actually, when including my student years, it's now 50 years this year, believe it or not, since I've been in this game. It seems like a hell of a long time. But you get pretty tunnel vision, and I don't really look at what other companies are doing that much. I don't really know how much better a Barrick is than a Newmont or vice versa, or where the mid-tier producers are good. I'm not really an investor in those companies, so I don't take much interest in it. I've got a whole handful of junior explorers that I'm invested in, and I really like them, but I don't really follow too closely what they're doing. I've got two companies, big producers, Pan American and Equinox, that command a lot of my attention. I've got two juniors, Lumina Gold and Luminex Resources, that are very much in my sphere, because it's my old Lumina team that is running those, and these guys are smart and they're good, and they're, we're trying to build value in the exploration area. So I'm very close to those companies, but I'm sorry I can't really tell Mr. Garcia what other companies are good or what other companies are bad. I just am not. I could give them gut opinions, but that's not really helpful.
Well, I wanted to touch base on one thing you mentioned earlier when you said how long you've been in the industry and how you got into it. We really would like to end off with a personal note. If you could basically give our viewers an understanding of how someone gets involved in your line of work. We used to live, our backdoor neighbors in a previous location were both geologists, husband and wife. Wow. And I thought, wow, that sounds like a really, I don't know, it didn't sound exciting, didn't sound glamorous, but when people say, gee, this guy is the director and chairman of a gold and silver mining company, now that sounds pretty interesting. So how did you get involved in this, and would you do it again?
Well, when you talked about those two geologists, that geologist couple, it made me think that I couldn't be more opposite. I'm married to a doctor, and I really think it's a true combination of sort of opposites, because the one thing that has really been a key thread through my whole career is the ability to embrace risk. In fact, not just embrace it, but run into it. I just didn't have a fear of anything in my whole career. I wanted to go to weird and strange places like Bolivia and Haiti and West Africa and Russia, and crazy places in Peru right after, we bought a mine in Peru 2 years after the mine geologist and the chief and the mine manager were assassinated by the Shining Path guerrilla movement. We bought it, the same mine, with 180 security people there. But it worked beautifully. I mean, it was just at the turn of Peru, and it turned out really well. So I've really embraced risk. I'm the true glass half full guy. I don't see negatives in anything almost. And my wife's the opposite. She's a doctor. She knows all the things that can kill you and hurt you. And she's the glass half empty kind of person. But that's where the opposites have attracted to some degree in our marriage. Being married to another geologist, I can't imagine. I can't imagine that in certain ways. So, but I do think that for any entrepreneur, you've really got to be comfortable with risk. You've got to be wanting to roll the dice. And the trick in the mining game is to roll it many times, have many, many eggs in many baskets, buy a lot of lottery tickets, because you just never know which one's gonna hit. I must have drilled 50 or 60 properties before we finally found a mine, my first company. But we found a mine, and we were lucky enough to make a deal that actually gave most of the value of that discovery to our shareholders. And that's, again, not always the case. So, embracing risk is one. Number two, being, impatient and hardworking. Of course, that kind of goes without saying. Pretty motivated to get up early in the morning and go to bed late. Those type of things. And also exposing yourself to luck. I mean, it's a business that is such high risk. It's high risk in every area. It's more high risk than most professionals in the industry even are aware of. If they think for very long, they realize there's risk beyond all of their own professional area: social, political, economic, global, macro, micro, technology risk, exploration risk, discovery risk, all that stuff. It's just everywhere in this business. And you have to be lucky. You have to be lucky. You have to also sit back, I think, and because we're in such a cyclical world, you really have to try to, take advantage of those cycles. It sounds so easy and it's so hard to do. Buy low, sell high. I mean, I've done that many, many times in my career, some luckily and some very much by planning. And I could go on and on. I do think there's a certain number of characteristics that work. I don't know why more people don't succeed in this business, because it doesn't seem to be real rocket science. But good entrepreneurs, they read a lot, they travel a lot, they understand how the world works. They like I said, they take risks all over the place. Those are some of the things that have worked for me. And I think if I analyze other risk takers and successful entrepreneurs, not just in mining, but in many areas, it's kind of what works for them too.
I'll add a little sidelight that I think that you and your wife might actually be complementary, but in the same way, where she and you may be both looking below the surface for underlying factors and underlying things that are clues and indicators to what might be the real payoff that you're looking for, the real answer to the puzzle. So maybe you have more in common than you realize. We've been speaking with Ross Beaty, the chairman and director of both Pan American Silver and Equinox Gold. Ross, thank you for joining us this first time on Liberty and Finance.
My pleasure.
To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com, Bullion Sales. You'll see my name, Dunnigan Kaiser, my phone number, and my associate, Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.